If you had the chance to buy a quantum computing stock in 2023 when it was trading for less than $1, would you have done it? Most people would answer yes. That is the easy answer after the fact. After a stock has already risen more than 2,000%. Everyone can see the opportunity. Everyone can say they would have recognized it. Everyone can imagine that they would have been calm, rational, and decisive at the bottom. But that is not how markets work. The opportunity never looks obvious when it matters most. When a stock is under $1, most people see danger, not opportunity. They see uncertainty. They see tiny revenue. They see dilution risk. They see cash burn. They see a business model that is not yet proven. They see a chart that looks broken. They see a sector nobody is paying attention to. Then, after the price rises, the same people see genius. This is one of the oldest patterns in markets. People want certainty before they buy. But by the time certainty appears, much of the return is already gone. That is why I want to start with the idea of a woodshed signal. Think of a musician. Anyone can walk onto a stage and try to play a guitar. But when someone has spent years practicing alone, when no one was watching, the performance reveals the preparation. The quality cannot be faked. The discipline is built into the result. Investing works the same way. Anybody can say quantum computing is exciting in 2026. After NVIDIA is making announcements, after more companies are going public, after the sector has already caught fire, after the price charts have become impossible to ignore. That is not preparation. That is reaction. The woodshed is doing the work before the crowd cares. It is studying the sector when the companies are too small for most investors to take seriously. It is understanding the architectures before the headlines arrive. It is knowing which companies have revenue and which are only promises. It is knowing which businesses are building real systems and which ones are surviving on stories. That preparation is what creates the ability to act when the signal appears. And right now, quantum computing is entering a different stage. 6 months ago, there were only a few publicly traded pure-play quantum companies. Now there are more, and several more are moving toward public markets. The investable universe is expanding. New architectures are becoming publicly accessible. Investors are no longer forced to place one blind bet on one approach that changes the game. But it does not remove the risk. In fact, it may increase the temptation. When a sector expands quickly and prices move violently, the investor's problem changes. The question is no longer simply, is this technology real? The question becomes, how much of the future is already priced in? And am I making a calibrated decision or an emotional one? That is the core of this entire discussion. Quantum computing may become one of the most important technological shifts of the next decade. It may create enormous value. It may produce a small number of huge winners. It may also destroy capital for people who buy stories, ignore dilution, and confuse excitement with probability. Both things can be true. The technology can be real, and many stocks can still be dangerous. The sector can have massive upside, and your entry point can still be wrong. The future can be extraordinary, and your sizing can still ruin you. This is why we need a framework. Before we go through the companies, I want you to understand a concept from mathematics called the 37% rule. The basic idea is that before making a major decision, you spend the first part of the process observing. You do not commit immediately. You study the options, you build a baseline, you learn what good looks like. Then when you see something that is clearly better than what you have already observed, you can act with more confidence. I like this concept because it is not about prediction, it is about calibration. Most investors enter a new sector with no baseline. They see a headline, they see a stock moving, they see someone online talking about a breakthrough, they feel fear of missing out, then they buy. That is not investing, that is reacting to stimulation. The look phase is different. You observe first, you learn the landscape, you understand the categories. You compare the businesses, you separate revenue from hope, you separate architecture from marketing, you separate institutional validation from empty press releases. Only after that can you judge whether a move is signal or noise. That matters especially in quantum computing, because this is not one technology. There are 4 main ways to build a quantum computer, and for the first time, all 4 are becoming publicly investable. That is important. If a sector is early and you do not know which architecture will win, you do not want to think as if there is only one path. You want to understand the different paths, the companies pursuing each one, and the risk-reward profile attached to each approach. The first company to discuss is D-Wave Quantum D. Wave is the example that makes people feel the pain of hindsight. This was the stock that traded below $1 and then moved dramatically higher. A $10,000 investment near that earlier point would have become a very large sum. That is the receipt that tells people something about the sector. But the receipt alone is not enough. You have to understand what D-Wave does. Wave uses a superconducting approach called annealing. In plain language, its systems are designed to solve optimization problems that exist right now. Supply chain routing, scheduling, drug discovery, financial risk modeling, problems where there are many possible combinations. And the goal is to find better outcomes faster. That matters because one of the big questions in quantum is commercial usefulness. Some quantum companies are building for a future that may take many years. D-Wave has an approach with applications that customers are already using today. Their full year 2025 revenue was up 179% year over year, but the early 2026 numbers were what made the signal stronger. In January and February alone, D-Wave booked more new contracts than the company's entire 2025 annual revenue. That is the kind of data point investors have to pay attention to, not because it guarantees success, it does not, but because revenue acceleration can indicate that a technology is moving from story toward adoption. There is another piece that many people may miss. In January 2026, D-Wave completed an acquisition that gives it a second quantum architecture. In addition to its annealing system, it now has gate model capability. 8 qubits operational, 17 expected by mid-2026, 49 by 2027. That gives D-Wave more than one path. It is no longer only the annealing company. It is attempting to build a broader quantum position that can be valuable. It can also add execution complexity. Multiple architectures mean more optionality, but also more capital requirements, more technical demands, and more ways for management to be stretched. So when I look at D-Wave, I do not see a simple story. I see a company with real customer traction, strong recent contract momentum, a first-mover narrative, and an expanded architecture strategy. I also see a highly speculative company in a young industry where valuation, dilution, and execution risks still matter. That is the balanced view. The second company is IonQ. IonQ uses a very different architecture called trapped ion. Instead of superconducting circuits, it uses individual atoms held in place by electromagnetic fields. Trapped ion systems are known for precision. IonQ is also the largest quantum pure play by revenue and market capitalization. When a company becomes the largest pure play in an emerging sector, it often attracts a different kind of capital. Institutions may become more comfortable with it. Analysts may cover it more. It may become the default name for investors who want exposure but do not want to study every microcap company in the sector. That can be an advantage, but it can also make valuation more demanding. IonQ's backlog was $77 million in late 2025. Today, it is nearly 5 times that. Revenue tripled year over year, up 202%. These are important signals because backlog and revenue growth show that the company is not only telling a story, it is converting interest into contracted demand. IonQ also announced a $1.8 billion acquisition of Skywater Technology, a trusted U.S. semiconductor foundry. If that deal closes, IonQ would control more of the manufacturing process from start to finish on US soil. That matters for several reasons. First, quantum hardware is not only software, it depends on manufacturing, supply chains, precision, and scaling. Owning or controlling more of the manufacturing stack can reduce dependency. Second, US-based manufacturing can matter for government and defense contracts and strategic technologies. The location and control of production can be as important as the technology itself. Third, vertical integration can create advantages if done well, but it can also create risk if it requires large capital, distracts management, or integrates poorly. So IonQ represents a different kind of quantum bet. It is larger, it is more visible, it has growing revenue and backlog, it is trying to build strategic control over manufacturing, it is positioned for government-related opportunities. But because it is larger and more visible, investors must ask whether the market has already rewarded it for those advantages. In emerging technologies, the best company is not always the best stock at any price. Price matters. Then there is Rigetti Computing. Rigetti uses superconducting gate model technology. This is another major architecture and one that investors often compare with the roadmaps of IBM and Google. Rigetti has a concentration issue that must be understood. 2 contracts represent a large portion of the company's 2026 revenue estimate, about 63%. One is an order from India SCDAC Research Organization for a 108-qubit system, and the other is a Novara QPU hardware delivery. The timelines have already shifted from the first half of 2026 to the second half. This is common in quantum hardware. Hardware orders slip, engineering timelines move. Systems take longer. Customers adjust. But common does not mean irrelevant. If a company's revenue depends heavily on a small number of contracts, execution risk is higher. If one timeline shifts, the financial results can change meaningfully. If a customer delays acceptance, revenue recognition can move. If the system underperforms, confidence can weaken. So with Rigetti, the bet is clear. You are betting on its superconducting roadmap and its ability to close the gap with much larger players. That can create upside because smaller companies can move dramatically if they prove themselves. But it also creates downside because larger companies have deeper resources, broader ecosystems, and more patience. When a small company is competing in hardware against giants, the path is narrow, not impossible, but narrow. Then we have Quantum Computing Inc. with the symbol cut. I want to be very direct here. This is the highest risk name on the list. Its 2025 revenue was only $682,000. The company S10K carries a major warning. It is facing securities fraud lawsuits. Short sellers have alleged that the company overstated its relationship with NASA and that some revenue may not have been real. Those are serious allegations. They do not automatically mean the company is worthless. They do mean that an investor must treat this as extremely speculative. There is a difference between risk and uncertainty. Risk is when you can reasonably estimate probabilities. Uncertainty is when you do not even know whether the information base is reliable. When a company has tiny revenue, legal issues, going concern concerns, and allegations around the quality of its commercial claims, you are operating in a high uncertainty zone that requires smaller sizing, greater skepticism, or no position at all if it is outside your circle of competence. The market can make these names move violently. That does not make them safe. In speculative sectors, the riskiest names often have the biggest percentage moves because the float is small, the narratives are intense, and liquidity can be thin. But volatility is not the same as value. You must keep your head on a swivel. So far, these are the more established quantum public names. We have covered superconducting, annealing, trapped ion, and some of the highest risk small cap territory. Now we need to look at the newer entrants because this is where the other architectures become visible. Inflection went public in February 2026 and uses neutral atom technology. Neutral atom systems have a scaling advantage. They are considered promising because they may reach thousands of qubits without some of the same engineering problems that other approaches encounter. Scaling matters because quantum computing is not just about building a few qubits. It is about building enough reliable qubits with low enough error rates to solve meaningful problems better than classical systems can. Inflection has some of the strongest institutional backing among the new entrants. NVIDIA selected Inflection for two separate quantum programs that matters because NVIDIA is not just a semiconductor company anymore. It is a central infrastructure layer for AI, accelerated computing, and increasingly adjacent deep technology ecosystems. When NVIDIA chooses a company twice out of a wide field, that does not guarantee success, but it is a meaningful validation signal. It tells you that serious technical evaluators see something worth supporting. Inflection also has two revenue streams: quantum computing and quantum sensing. That is important because sensing can be commercially useful earlier than fault-tolerant quantum computing. Inflection has deployed hardware, including systems on the International Space Station for NASA. Revenue topped $32 million last year, with 23% growth guided for this year. For a newly public quantum company that has real commercial traction, again, do not confuse traction with certainty, but compared with companies that have little or no revenue, Inflection has a more developed operating base. The combination of NVIDIA backing, neutral atom architecture, quantum sensing, and actual revenue makes it one of the more interesting new entrants to watch. Then there is Xanadu. Xanadu brings the fourth architecture, photonic quantum computing. Photonic systems use photons, and one engineering advantage is that they can operate at room temperature. That may reduce some of the cooling complexity that affects superconducting qubits. But the most interesting part of Xanadu may not be the hardware alone. It is the software. Xanadu built an open-source quantum programming framework called Penelane. It is used by a large portion of quantum developers worldwide. The source describes it as used by half of all quantum developers, with 160,000 monthly downloads and usage growth of 161% last year. That is not a small detail. Software adoption can create an ecosystem effect. If developers build with your tools, your position may matter even if the winning hardware architecture is uncertain. Penelane works across architectures. That means Xanadu has two possible investment cases in one company. One is the photonic hardware bet, the other is the software platform bet. That gives it a different risk profile from pure hardware companies. Hardware may take time, hardware may fail, but software adoption can create relevance across the sector if developers continue to use it. Still, Xanadu is speculative. The stock has been volatile since its launch in March 2026. Revenue remains early. The hardware case is not proven. The software layer helps, but it does not eliminate the risk. It gives the company another path. That is all. Another new entrant is Horizon Quantum, which closed its SPAC in March and began trading on NASDAQ. Horizon builds hardware-agnostic quantum software tools in plain language. That means it is trying to be useful regardless of which hardware architecture wins. Think of it as middleware. In many technology cycles, middleware can become valuable because it sits between developers, applications, and underlying infrastructure. If the hardware landscape is fragmented, the tools that make systems easier to use can become important. The attraction of a hardware-agnostic software company is that it does not need to pick the winning machine. It can benefit if multiple machines advance. But the challenge is that software layers must prove adoption, monetization, and defensibility. Open source ecosystems can be powerful, but they can also be hard to monetize. Enterprise tools can monetize, but they need customers, integrations, and trust. So the question for Horizon is not only whether quantum grows, the question is whether its tools become necessary in the quantum workflow. Then there are two microcap names in quantum security. CLSQ is working on POST, quantum encryption chips designed to protect systems before quantum computers can break today. S encryption standards. Archit works on quantum safe key distribution. These are extremely early. They are pre-revenue. They are speculative, but they point to an important part of the quantum ecosystem. Quantum is not only about computing, it is also about security. If powerful quantum computers can eventually threaten existing encryption, then governments, banks, defense systems, cloud providers, and critical infrastructure operators will need quantum-safe systems that could create an entire market. But the timing is uncertain, the standards are evolving, the customers may move slowly, the companies are small, the capital risk is high. So these names belong in the most speculative category, not the core. Beyond the currently public companies, there are upcoming IPOs that could change the public quantum market even more. Quantinuum, majority owned by Honeywell, filed its confidential S-1 in January 2026 and is targeting a valuation around $20 billion. If it comes public at that scale, it would be the largest quantum company to enter public markets by far. That matters because large IPOs can reset sector valuation, they can bring institutional attention, they can create benchmarks, they can also absorb capital and change how investors compare smaller names. Then there is IQM out of Finland, which is expected to go public through a SPAC at a $1.8 billion valuation, with closing expected in June. And Pascal out of France is targeting a $2 billion SPAC listing in the second half of the year by the end of 2026. There could be 8 or more publicly traded quantum pure plays across the major architectures that has never happened before in this sector. And it fundamentally changes how a quantum portfolio can be built before. An investor might have been forced to choose between a handful of names. Now there's enough breadth to think in layers, architecture layers, revenue layers, maturity layers, infrastructure layers, software layers, security layers, speculative layers. That is a more sophisticated opportunity, but also a more complicated one. More choices do not automatically mean better decisions. Sometimes more choices create more ways to make mistakes. This is where infrastructure companies become important. Amazon Web Services hosts multiple quantum hardware providers on a single cloud platform. Microsoft Azure hosts several as well. NVIDIA's software platform integrates with a large portion of the world's quantum processors, and its venture arm has backed companies such as Quantinuum, Q-Era, and PsiQuantum in large funding rounds. These infrastructure companies are not pure quantum bets. That is the point, Amazon. Microsoft and NVIDIA do not need quantum to succeed. They already have enormous businesses. They have cash flow, they have customers, they have distribution, they have developer ecosystems, they have balance sheets, but if quantum succeeds, they may become toll collectors. They can benefit by providing cloud access, software tools, chips, platforms, integration, and capital to the ecosystem. This is one of the most important principles in emerging technology investing. Sometimes the best risk-adjusted exposure is not the company trying to discover gold. It is the company selling the picks, shovels, maps, and transportation to the entire gold rush. Pure plays can produce the biggest returns. Infrastructure companies can produce more durable exposure. That does not mean infrastructure is risk-free. Their quantum exposure may be too small to move the entire business. If you buy Amazon for quantum, you are really buying cloud, retail, advertising, logistics, and many other things. If you buy NVIDIA for quantum, you are also buying AI, data centers, GPUs, networking, software, and valuation risk. So infrastructure exposure is not a direct quantum bet. It is a diversified platform bet with quantum optionality. That may be better for many investors. Now let us return to the original question. Are quantum stocks still at good entry points today? The answer is maybe. That may sound unsatisfying, but it is the right answer if you are being honest. A good company can be a bad purchase at the wrong price. A risky company can become attractive if the price is low enough and the sizing is small enough. A sector can have enormous long-term potential and still go through brutal drawdowns. Quantum stocks have already moved. The pure play universe has expanded. The narratives are stronger, institutional. Attention is increasing, more retail. Investors are discovering the theme. All of that increases opportunity and risk at the same time. The 37% rule matters here. If you have watched the landscape, studied the architectures, identified the revenue leaders, understood the speculative names, and built a baseline, then you are better prepared than someone who only saw a headline. The next time one of these names moves, you can ask better questions. Is this move based on a real contract? Is it based on revenue acceleration? Is it based on architecture validation? Is it based on a strategic partnership with substance? Is it based on government funding? Is it based on a technical milestone, or is it just a press release, social media momentum, and fear of missing out? That is the difference between signal and noise. Most people in speculative sectors do not have a baseline. That is why they buy high and sell low. They do not know what the company is worth, what the architecture is, what milestones matter, or what risks are hidden in the financial statements. They only know how they feel. And feelings change with price 6 months ago. The fear around quantum was simple. What if it does not work? What if the science is not ready? What if the companies burn through cash before the technology arrives? What if customers do not adopt it? What if the whole sector is too early? Today, after the stocks have moved and new companies have gone public, the fear has flipped. Now the fear is, what if quantum does work and I am not in it? That is the same uncertainty, but the emotion has changed direction. When a stock is down, fear says, do not buy. When a stock is up, fear says, you must buy now. It is the same fear wearing a different costume. This is a very important psychological signal. It is not necessarily a buy signal. It is not necessarily a sell signal. It is a pause signal. When you feel urgency in a speculative sector, stop and ask whether the urgency is coming from the data or from the price movement. That one question can save a lot of money. Every one of these companies has another major issue that cannot be ignored: cash burn and share issuance. Many early-stage quantum companies are burning cash. They need to fund research, engineering talent, hardware, manufacturing, sales, and operations. If revenue is small and costs are high, they must raise capital. Raising capital often means issuing shares. That creates dilution. Even if the company succeeds, your slice of the company can shrink over time. This is one of the biggest trade-offs in early-stage hardware investing. The technology may advance, but the capital structure may also expand. The stock price can rise while existing shareholders are diluted. If the company repeatedly raises capital at weak prices, long-term returns can suffer. So the question is not, is quantum exciting? It clearly is. The question is the decision calibrated? Am I paying a price that makes sense relative to the stage, revenue, cash burn, dilution risk, technical risk, and possible upside? That is how you have to think. Now let us talk about sizing. If I had $100 to allocate across quantum exposure today, I would not put it all into one company. I would think in tiers. The first tier is the infrastructure layer. This would receive the largest allocation, perhaps $50 out of 100. These are companies like Amazon, Microsoft, NVIDIA, and other large infrastructure players connected to quantum platforms, cloud access, developer ecosystems, computing infrastructure, and strategic investments. The reason this layer gets the biggest allocation is that these businesses generate real cash flow today. They are not dependent on quantum for survival. If quantum takes longer than expected, they still have core businesses. If quantum succeeds, they may benefit as toll collectors. This is the anchor. It is not the most explosive layer. It is the more resilient layer. The second tier is pure play builders. This might receive $35 out of 100. These are the companies where quantum is the whole business: D-Wave, IonQ, Rigetti, Inflection, Xanadu, Horizon, and others depending on how you evaluate them. This is where the outsized returns may come from if commercialization advances over the next 2 to 3 years. These companies have more torque to the theme. If they win, the returns can be dramatic, but they also have more risk. Revenue may be early, cash burn may be high, technical milestones may slip, dilution may continue, valuations may detach from fundamentals, some companies may fail. This layer requires more discipline. You do not size it as if every company will win. You size it knowing that a few may produce large returns and others may disappoint badly. The third tier is the penny dreamer layer. This might receive $15 out of 100. These are the highly speculative early-stage names, companies like CLSQ, Arcit, perhaps the most speculative parts of the quantum security or software ecosystem. Maybe certain new entrants depending on price, liquidity, and development. The idea is simple. A single breakthrough could multiply the investment, a failure could wipe it out. That means this layer must be sized so that failure does not damage the whole portfolio. Speculation is not inherently wrong. Uncontrolled speculation is wrong. There is a major difference. A small speculative sleeve inside a broader system can create upside optionality. A portfolio made entirely of speculative sleeves is not a portfolio. It is a lottery ticket. If someone does not want to pick individual names, there are quantum-focused ETFs. The Defiance Quantum ETF has been around the longest in the space, and now there are several other quantum-focused ETFs that did not exist a year ago. A basket can reduce single company risk, but it does not remove sector risk. If quantum as a theme falls out of favor, the whole basket can fall. If the ETF owns weak companies or overweights expensive names, the result can still disappoint. So even with ETFs, you must study the holdings, the expense ratio, the concentration, the methodology, and how much pure quantum exposure you are actually getting. The point is not to outsource thinking. The point is to choose the structure that matches your knowledge and temperament. Now step back and look at the larger cycle. Quantum computing today has some similarities to other early technology waves. There is real science, there is real promise, there is real government interest, there is real capital flowing in. There are also exaggerated claims, promotional companies, uncertain timelines, and investors who do not understand what they own. That combination creates enormous volatility in such environments. The best investors do not try to predict every short-term move. They build watch lists, they define signals, they size carefully, they wait for dislocations, they separate the architecture from the stock price. They update their views as new information arrives. They do not fall in love with one company. They do not buy only because the chart is going up. They do not sell only because the chart is going down. They ask what has changed in the fundamentals. For D-Wave, the questions are contract growth, customer usage, annealing adoption, gate model progress, cash burn, and dilution. For IonQ, the questions are backlog conversion, revenue quality, Skywater integration, manufacturing control, government contracts, and valuation. For Rigetti, the questions are contract delivery, roadmap credibility, competitive position against larger superconducting players, and customer concentration. For CUP, the questions are legal risk, revenue credibility, cash position, going concern risk, and whether the business can prove itself beyond controversy. For Inflection, the questions are NVIDIA validation, neutral atom scaling, sensing revenue, NASA, related deployment, and whether early commercial traction can continue. For Xanadu, the questions are photonic scaling, pentalane adoption, software monetization, revenue growth, and whether the software platform creates durable value regardless of hardware outcome. For Horizon, the questions are middleware adoption, customer traction, revenue model, and whether hardware-agnostic tools become essential. For CLSQ and ARKit, the questions are quantum, security timing, PREP, revenue survival, standards adoption, and whether demand arrives before dilution overwhelms shareholders. For upcoming IPOs like Quantinuum, IQM, and Pascal, the questions will be valuation, architecture, revenue capital needs, strategic partners, and how they change the competitive map. That is how you think in systems, not which stock will go up tomorrow. But what are the key variables that determine whether this company compounds value or destroys capital? Quantum is exciting because the payoff could be large, but the payoff is not the same as the probability-weighted return. That is a crucial distinction. A company can have a huge total addressable market and still be a poor investment if the probability of success is low, dilution is high, and the price is excessive. Another company can look boring but produce better returns because the risk-adjusted setup is better. Investors often confuse story size with expected return. A big story does not automatically create a good investment. The story has to be translated into revenues, margins, cash flows, and durable competitive advantage. In quantum, many companies are still far from that point. That means the watch phase remains important. The look phase does not mean doing nothing forever. It means learning enough that action, when it comes, is based on observation instead of emotion. If the sector corrects, you want to know which names deserve attention. If one company announces a major contract, you want to know whether that contract is meaningful relative to its revenue base. If a stock doubles in a week, you want to know whether the move reflects a real change or just enthusiasm. If a company issues shares, you want to understand how much dilution occurred and whether the capital raised improves its survival odds. This is the work. Most people do not want to do this work. They want a ticker. But a ticker without a framework is dangerous. The real opportunity in quantum may not be one stock. It may be the ability to build a structured exposure across a very early technology wave while avoiding the mistakes that destroy retail investors in speculative cycles. That means you need three things: a map of the sector, a sizing discipline, a psychological discipline. The map tells you the architectures, companies, infrastructure players, pure plays, software tools, security names, and upcoming IPOs. The sizing discipline prevents any single idea from destroying you. The psychological discipline prevents fear from pushing you out at the bottom and FOMO from pulling you in at the top. That third one is the hardest, because the same person who refused to buy quantum stocks when they were ignored will often chase them after they have risen 500%. The facts did not become 10 times better. The emotion became 10 times stronger. If you can see that in yourself, you are already ahead of most investors. Markets are not only about information, they are about behavior. If you cannot control behavior, information will not save you. Now, let me make the final point very clearly. Quantum computing may become one of the greatest technological shifts of our lifetime. It may change optimization, chemistry, materials, science, security, logistics, finance, and computation itself. It may create companies that become far larger than they are today, but it may also take longer than investors expect. There may be bubbles along the way. Some companies will probably fail, some will be acquired, some will dilute heavily, some will overpromise, some will solve pieces of the problem, but never become great businesses. A few may become extraordinary winners. That is the nature of early technology investing. The goal is not to pretend you know the future. The goal is to build a structure that gives you exposure to the future without letting uncertainty destroy you. That is why I would think in layers infrastructure first, because it is the most durable pure plays second, because they provide upside. Speculative dreamers third, because they provide optionality but must be contained. And above all, I would keep observing, because in a sector this early, the most valuable asset is not only capital, it is judgment. Judgment improves when you study before you act. Judgment improves when you compare before you commit. Judgment improves when you know what you are waiting for. Judgment improves when you are not desperate to buy something just because other people are excited. The woodshed signal matters because it reminds us that good investing comes from preparation done before the applause. If you want the next 10-bagger, you cannot only show up after the 10-bagger has already happened. You have to study when it is uncomfortable, quiet, uncertain, and lonely. But you also have to avoid the opposite mistake. You cannot buy every tiny company just because one of them may become great. That is not investing, that is buying lottery tickets with a story attached. The right approach is harder. Study the sector, understand the architectures. Separate real revenue from promises. Watch contract momentum. Watch backlog conversion. Watch cash burn. Watch dilution. Watch technical milestones. Watch strategic validation. Watch the infrastructure layer. Watch the IPO pipeline. Then, when price, progress, and probability line up, act with discipline. That is how you turn a speculative theme into an investable framework, not by eliminating risk. Risk cannot be eliminated, but by knowing what risks you are taking, why you are taking them, and how much of your capital deserves to be exposed. That is the difference between being excited about quantum and investing intelligently in quantum. One is emotion, the other is a system. And in markets, over time, systems beat emotions.